So you'd think an insurance company just wants more customers. More policies, more premiums, more profit. Sounds pretty obvious. It isn't always how this business works. Here's the part almost nobody understands about this business right now. Sometimes an insurance company will walk away from tens of thousands of paying customers on purpose, not because it dislikes them, because the math on those specific policies no longer works at all. Most people think an insurer sells protection. It doesn't, not exactly. What it actually sells is a carefully priced bet on risk. That price has to match reality, or the company starts bleeding money fast. This single idea explains one of the strangest and most controversial business stories in recent memory. You will see the math, the ceiling regulators placed on it, and the moment that math collided with a real disaster. This is not really a story about one company abandoning customers. It is a story about what happens when a price is not allowed to reflect the risk underneath it. Stay with me, because both sides of this argument turn out to have real evidence behind them. The basic bet behind every policy. Insurance runs on a simple idea at its foundation. Collect small payments from many people to cover the rare, large losses of a few. To make that work, a company has to price each policy close to the actual risk it represents. A home in a dense forest with dry brush nearby carries more risk than a home surrounded by concrete. Distance from a fire station, roof material, and local fire history all factor into that risk picture. Actuaries build detailed models estimating exactly how much risk that represents in dollars. If the approved price is below that real risk for long enough, the math simply does not close. Every insurer also buys its own protection, called reinsurance, to cover catastrophic losses. Reinsurance costs have climbed sharply in recent years. Adding another expense insurers must somehow price in. That single expense alone can shift the math on an entire regional portfolio of policies overnight. The ceiling that rates could not clear. Here's the part that sounds backwards until you think it through. In California, insurance rate increases must be approved by state regulators before they take effect. For years, insurers were limited in how they could factor in future risk when requesting new rates. Older rules restricted the use of forward-looking wildfire models and the full cost of reinsurance in those requests. Meanwhile, the actual risk on the ground was changing fast. Wildfire seasons grew more severe, and rebuilding costs climbed sharply nearly every year. The gap between approved rates and modeled risk widened year after year. An insurer files a request, and regulators can ask for additional data, hold hearings, and negotiate the final number. Consumer groups can formally challenge a proposed increase during that process as well. Getting a rate increase approved could take months or even years of review. By the time an increase finally arrived, the underlying risk had often grown again in the meantime. The rate an insurer was allowed to charge and the rate an actuary believed the risk actually caused kept drifting further apart. The trap of selling insurance below cost. Here's the trap hiding underneath this entire situation. An insurer stuck charging less than the real risk is nearly guaranteed to lose money on those policies. One major carrier later disclosed a striking number about its California operations. Over 9 years, it paid out roughly $1.26 for every single premium dollar collected. That adds up to billions of dollars in cumulative losses on paper. A company facing numbers like that has only a few real options. Raise rates, reduce how many risky policies it carries, or leave the market completely. None of those options are popular with the customers left holding an expiring policy. State Farm was not alone in making this choice. Several of California's largest home insurers paused or restricted new policies over the same few years. The 72,000 policies and the fire that followed. Meet State Farm's California pullback. In May 2023, the company stopped accepting new home insurance applications in the state entirely. In March 2024, it announced it would not renew about 72,000 existing policies. Roughly 30,000 of those were homes, concentrated in the highest wildfire risk zip codes, in some mountain communities. While over half of local policies were affected by the decision, the company cited inflation, rising reinsurance costs, and regulatory limits as its stated reasons. The non-renewals took effect that July. Then, in January 2025, catastrophic wildfires tore through Los Angeles County. In one heavily affected neighborhood alone, well over 1,000 homes had already lost their State Farm coverage months earlier. Some homeowners whose coverage had already lapsed found themselves suddenly and painfully exposed. Insurers across the state eventually paid out more than $23 billion connected to those fires. State Farm requested emergency rate relief soon afterward. Regulators approved a 17% increase, later confirmed through a formal settlement in 2026. With private insurers pulling back, far more homeowners turned California's FAIR Plan, the state's insurer of last resort. Enrollment in that backup plan surged past 600,000 policies, roughly doubling in just a couple of years. Coverage through the backup plan is often more limited and considerably more expensive than a standard policy. That backup plan was never designed to carry that much of the market on its own. The part that complicates the simple story. To be fair to every side here, this story is not one-directional. California regulators have since updated the rules to allow more forward-looking risk modeling in future filings. That change is designed to help rates track real risk more closely going forward. Regulators frame the shift as a way to keep more insurers willing to operate in the state long term. At the same time, State Farm has faced its own scrutiny. State regulators opened an investigation into how the company handled certain wildfire claims afterward. The review reportedly found a pattern of issues across a significant share of the claims examined. Hundreds of alleged violations were identified in that review. Neither side of this story is simply the villain. Rate rules lag behind fast-changing risk, and a major insurer's claims process drew real complaint of its own. Both problems can be true in the same market at the exact same time. The real math of insuring a risky state. In the optimistic scenario, rates track risk closely enough that insurers stay and keep competing. Homeowners get more choices, and prices stay grounded in something close to the real cost of risk. In the realistic scenario, approved rates lag behind the real risk for too many years running. Private insurers pull back, and the public backstop plan absorbs the customers nobody else will take. Similar tension is now playing out in other disaster-prone states across the country. An insurance company doesn't leave a state because it stopped caring about its customers. It leaves when the price it's allowed to charge no longer matches the bet it's actually being forced to make.